Hi, everybody. This is Alan Ellman, the Blue Collar Investor, with today's option selling question of the day. Today's question comes from Courtney. Alan, please tell me what parameters you recommend when setting up your poor man's covered call trades. How do you factor in premium extrinsic value and strike prices? Thank you, and it's signed Courtney. Okay. Let's talk about the poor man's covered call, PMCC trades. These are covered call writing like strategy. So it's not traditional covered call writing. It's a special way of using covered call writing. Instead of buying a stock or an exchange traded fund as the underlying security, deep in the money leaps option is purchased instead of the actual stock or ETF. Now, you could sell weekly or monthly short calls against this long call position. The technical term for the strategy is the long call diagonal debit spread. Now, every strategy, including the poor man's covered call, has its pros and cons. So if those of you who are watching this video and not just listening to it, let me read from the screenshot first the advantages and then the disadvantages of the strategy, because there's a lot more to the poor man's covered call than covered call writing, but cheaper, which is the way it's framed in many venues on the internet. So, pros. There's certainly less capital required when we make our trade because the cost of the leaps option is much lower than that of the individual stock or exchange traded fund, which means because the investment is lower, the return on our investment will be that much greater. For those who are using margin, which I don't really encourage for retail investors, but for those using margin, it'll reduce the margin requirement. It also reduces the capital risk because we're spending less money for that underlying security, a long position. Now, time value or theta decay is lower for leaps options than for stocks. And there's also less time value paid for leaps options. Now, when to enter a poor man's covered call trade? It's always best to enter it in a low implied volatility environment, because towards the end of the contract for that deep in the money leaps option, which expires 1 or 2 years out, the implied volatility may be greater, and that will benefit our bottom line. We just don't know what the implied volatility is going to be a year or two from when the trade is entered. Another advantage, and the last bullet on this screenshot, is that many brokers will allow the poor man's covered call in self-directed IRA accounts. Now, every strategy, including this one, has its disadvantages. The disadvantage that concerns me the most is the long-term commitment. Remember, we're buying leaps options, so we're making a commitment 1 to 2 years out. Now, yes, we can close it early, but the general thinking is we're going to keep this position for the long term, and that's how until expiration of the leaps contracts. And even then, if we want to continue, we could roll that leaps option. Now, all this information on this strategy is in one of my books, Covered Call Writing Alternative Strategies. Now, another disadvantage is we cannot calculate maximum profit or break even, and that has to do with the implied volatility at the time the contract is expiring. Now, because the liquidity of the leaps option is lower, it'll have wider bid-ask spreads and lower option liquidity with leaps because less people are trading leaps than monthlies and weeklies. Also, there is a smaller pool of stocks with leaps and weekly options. Because we're taking a long-term position here, we have to deal with earnings reports. And earnings reports could be very favorable, but they can also cause a huge decline in share price if those reports disappoint. And if we're taking a long-term position, we're going to go through many, many, many earnings reports. Now, blue chip companies are generally the ones we're going to use for long-term positions. Cash-rich companies that have been proven over years and decades. Now, these companies have lower premiums than, let's say, smaller companies, tech companies, for example, that have a little more implied volatility and therefore higher premiums. So that's something to consider as well. Now, Leaf's options eventually expire, like all options do. And at that point in time, we have to consider rolling the option. That costs money. Where do we get that money from? So this is something we have to factor in as well if deciding that this is a strategy for us. And finally, the last bullet point on the right side is that as a Leafs owner, we do not capture dividends. As a share owner, if dividends are distributed, yes, if we own that security on the X date, we will receive the dividend. So those are the pros and cons of the poor man's covered call that we have to factor in when making our trading decisions. Now, the blue collar investor has a trade initialization formula. This formula will let us know whether or not a particular trade is appropriate for the poor man's covered call. Here's the formula. The difference between the two strikes, the leap strike and the short call, whether it's a weekly or a monthly, plus the initial short call premium must be greater than the cost of the leaps. This will allow us to close both legs of the poor man's covered call trade at a profit if the price of the underlying security rises exponentially and we're forced to close the trade because we don't want to put a lot more cash into the trade to close and roll the short call. It'll have a huge intrinsic value component, which we may not want to pay. Now, you'll see in a moment, in a couple of slides, you'll see the BCI Poor Man's Covered Call calculator, which will display a bold yes if the trade structuring is appropriate, which means if it meets the formula in the top here that I alluded to, and that means it's an appropriate structuring of the trade, or a no if the formula is not met. So that makes it very easy for us to determine whether or not we're starting at a good place. Here's a hypothetical trade for the poor man's covered call. On 12/20/23, BCI trading at 31. Okay, at that point in time, the January 17th, 2025, so a little more than a year out, that deep in the money $15 leaps has an ask price. Remember, we sell at the bid, but we buy at the ask of $18.50. Now, the January 19th, 1 month out, 35 out of the money call has a bid price of 90 cents. So what we're going to do is we're going to feed that in to the BCI Poor Man's Covered Call calculator, and the information is entered in the white cells at the top of the spreadsheet. And the statistics that you see here are the ones we gleaned from the option chain. Now, the formula is met where you could see this bold red over here. And that tells us that it is inappropriate because at that point in time, if the trade is closed, we will have generated a $2.40 per share profit. That results in a 4.86% return. And if the price of the stock moves up to or beyond the out of the money 35 strike we see on top here, that would give us an additional upside potential of 21.62%, which means that we have the possibility, the potential of a 1 month return of 26.49%. Okay, it also shows us what our maximum loss could be. In this case, it's $17.60 per share if the price goes to zero. We know that is hardly likely, but you want to know what the worst case scenario is. So you want to make sure to answer the question, Courtney, is that we have correct strike prices for both the short call and the deep in the money leaps, and that it meets our trade initialization formula. And this is after we've done our screening. Now, again, most of the time we're going to be using blue chip type companies, cash rich companies that have proven to be successful over years and decades. And that's why I say blue chip. Let's summarize. The BCI Poor Man's Covered Call Trade Initialization Formula will give us a guideline as to the suitability of our PMCC trades. We want to ensure that if both legs of the trade are closed because of exponential share appreciation, that we will close at a profit, not a loss. We don't want to be directionally correct and still lose money. The poor man's covered call strategy allows us to enter our covered call trades with less capital risk. However, the strategy is way much more than covered call writing, but cheaper. Do not believe that if you see that someplace else in another venue, that it's just simply covered call writing, but cheaper. Ignore it, because you have to understand all the moving parts inherent in this strategy. And you must be sure to master all of the pros and cons and all the moving parts of this strategy before you make a decision that this strategy is in fact the right one for you and your family. It may be, and it may not be. You must be educated. Ladies and gentlemen, before I go, as I always do, I want to let you know that all of the library of Ask Alan videos, well over 200 now, are located on the premium member site. Just log in and scroll down, and you will see, I highlighted in yellow, but it's in white on your, all of the Ask Alan videos. You'll see the first 10 on the top, and then you'll click the link at the bottom to get the other 200 plus. We add a new one for our premium members every single month where we break down trades. Now on the right side towards the top, if you scroll down to A, you will get all of the Ask Alan video topics. Our 3 best discounted packages, starting with the BCI package, which is an acronym for our best and most comprehensive investment package ever offered by the blue collar investor. It includes 6 online video courses, about 2 hours each, with downloadable workbooks, 6 spreadsheets invented by the blue collar investor and found nowhere else, 5 of our best-selling books in ebook format, and our 13-month annual premium membership, where you get 4 reports of eligible option candidates, along with well over 250 training videos and dozens of other downloads and resources. The second of our 3 best discounted packages is our Trade Management Calculator package. This is an absolute must to anybody using covered call writing or selling cash secured puts. It allows you to enter your trades, get your initial trade calculations per trade and per portfolio. It allows you to adjust your trades with well over 20 different exit strategies, and then get your post-adjusted results per trade and per portfolio. It also includes a 28-page user guide, and it includes a PDF copy of my 8th book, Exit Strategies for Covered Call Writing and Selling Cash Secured Puts. It's 27 chapters of exit strategy information. The third of our best discounted packages is our CEO package, which is an acronym for combining exchange-traded funds with stock options. It includes 2 spreadsheets developed by the blue-collar investor, which assists us in setting up our portfolios and then archiving the results and comparing it to that of the S&P 500. It also includes my 9th book, Covered Call Writing, A Streamlined Approach, the PDF version of that book. To get more information on these best discounted packages, just go to our website, thebluecollarinvestor.com, and click on the link at the top that says Best Discounted Packages. You can also get items individually in our store, thebluecollarinvestor.com/store, and items can be purchased individually. Ladies and gentlemen, I want to thank Courtney very, very much for asking this question and allowing me to share the analysis with the entire BCI community. And I also want to thank you for taking the time to watch and or listen to this Ask Alan video number 217. Folks, I hope you enjoyed this presentation, but most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.